I'm very proud of what our firm has done over the last 20 years in the SPAC market. So it's actually closer to 1,000 SPAC IPOs and hundreds of de-SPAC transactions. And I know you all wanted to know that, so I figured I'd update it. It's great to see all the attendance today. Last year's conference wasn't nearly as exciting as this one. You can feel the difference. And maybe somebody out here will be able to explain to me what has changed. I just can't figure it out myself, but I'll try. So what 2024, 2025 proves more than anything else after 30 years of SPACs is that these vehicles are subject to market cycles like any other financial program, and we will continue to positively contribute to entrepreneurship when their utility is most needed. It is quite clear, and has been for a year, that once the number of listed SPACs seeking business combination partners decreased to well below 100, as opposed to the market highs 3 or 4 years ago when there were many hundreds of them, the need for more alternative public vehicles was inevitable, particularly since the IPO window hasn't fully opened, and according to a recent Bain report, there are 29,000 private equity portfolio companies that have been held by those firms for more than 5 years. But first, credit has to be shouted out loudly and clearly to those intrepid SPAC sponsors for continuing to believe in the program in spite of the business community ridicule, regulatory stigma, and political browbeating. And thanks further for all of you choosing to be here last year and this year in full support of the industry's continuation. And obviously to DealFlow, Steve, Brooke, for putting on this wonderful event. Those 57 SPAC sponsors in 2024 seem to have known what their naysayers didn't. Being oppositional, while not for the faint of heart, can pay off handsomely if the future stars align. They brought life and hope back into this left-for-dead industry, and so far the results continue to be encouraging. They have already announced and closed business combinations in 2025 that have been well received by the market, trade at levels above trust, and raised permanent capital on much healthier terms than we as a firm have experienced in the last couple of years. Our hats go off to those 2024 sponsors, and we trust that their sponsor economics bear fruit to justify the risk that they have taken. What was not clear last year, and no one could have anticipated, was the momentum ignited by the SPAC industry and the crypto community joining forces. Let's call it the SPAC crypto Big Bang moment in capital markets, although in reverse. It's gone from crypto and SPAC winters to a spontaneous heating up and expansion of these two separate but disruptive universes. It's hard to appreciate directionally what it means or where we will even go from here, but it's clearly significant, and it needs to be better understood to capture the full extent of the opportunity and mitigate future risks. After the proposed SPAC rules were finalized last year, even the rosiest of SEC commissioners in their remarks challenging the SEC's approval of the final rules were fatalistic and thought that the former SEC administration had levied the final death knell blow to the SPAC industry. Well, apparently not. As one of the great philosophers of our cinematic time said in The Princess Bride, he's not dead, just mostly dead, meaning he's slightly alive and still has some time left in him. It's almost poetic that the legacy of the former SEC administration is that its two comic book villains, SPACs and crypto, have teamed up and are poised to remake the capital market landscape together with the cooperation of the new zeitgeist at the SEC. And when I spoke to the chairman's office yesterday, they wanted to pass along that as opposed to being negative, the way the last 4 years under the Gensler administration is, this administration is neutral on SPACs, which is a huge positive. So I think we can all go forward and be comfortable that the SPAC industry is going to be treated properly going forward. Well, as we've advised the staff many times over the years, Until they are prepared to actually evaluate market structures, the issues aplenty with traditional IPOs, underwritings, and institutional investing, and come to appreciate and recognize the critical role that SPACs play in the capital markets, especially today, they won't come to terms with the reality that last year's final rules were just a futile attempt to curtail interest in these vehicles and were largely toothless and unhelpful for the investors that they purport to represent. As has been true at different points in the evolution of the SPAC industry since 1993, but even more so today, the exit options available for certain private enterprise is even narrower than we've seen in previous cycles. As we speak, the IPO window is only slightly open for the largest, highest profile offerings, and consequently a very large number of private equity, venture capital, and fund managers who have long held their portfolio investments past their appropriate aging are interested and eager to transact with SPACs. This is of particular note since the narrative at the end of the last cycle was that these gatekeepers, in particular, would be especially reticent to utilize SPACs as exits, given the outcomes that many experienced in the past. Turns out not to be the case at all. Numerous of the de-SPAC transactions announced already in 2025 involve private equity firms as counterparties. SPAC sponsors report significant sell-side activity from the same private equity firms on much more positive commercial terms than they've observed just a few years ago. With just 57 vintage 2024 SPACs listed last year, that created a buy-side scarcity value that quickly witnessed a flurry of positively announced transactions in the first half of 2025. Also, given the recognized experience of the same 57 serial SPAC sponsor teams, the comfort level between sponsors of SPACs and portfolio managers of funds has been much more organic and comfortable than the last cycle when much of it was all new to both sides. These announced deals have traded well, both before and after consummation of the deals, and redemption rates have dropped as a result. I believe that this is a direct result of more reasonable expectations by both constituents learning valuable market lessons from 21 and 22. Of real significance is that there seems to be a sophisticated understanding that if a perceived valuation are reasonable, the greater likelihood of raising capital, stocks trading above trust, and better long-term prognosis for all, a true longer-term view on how to better utilize SPACs as a stage exit and not a one-time event. This is a meaningful departure from the 21 approach of simply maxing out in the business combination enterprise value of the target by the sellers without regards to the ability to trade out their ownership position in the future. Notwithstanding that almost all SPACs have migrated offshore to avoid both the redemption excise tax and the perceived poor Delaware case law decisions, none of the inexperienced and naive posturing of deal teams on how to process transactions seems to be present during this cycle. It's another way of saying everybody in this room is more sophisticated and experienced, and we appreciate that. It helps get deals done. There isn't the uncertainty of getting fairness opinions, how to prepare projections, or when to employ special committees if necessary, nor the concerns presented when the SEC recklessly advanced the novel theories of gatekeeper liability. The parties are much more transactionally sophisticated and willing to accept the rules of the road on how to proceed without the silly wrangling that occurred last cycle over conventionally accepted SPAC terms and conditions. In part because of the intentional confusion caused by regulators and to a less extent even the cases that were adjudicated in Delaware Chancery Court. Even most of the recent Delaware decisions seems to have been much more favorable to the SPAC industry for those who follow. Several motions to dismiss have been granted. Although I would note one exception that recently occurred in a case in Delaware, and this was within the last few weeks. The Delaware Chancery Court decided not to grant a motion to dismiss, and the case was allowed to proceed due to the failure not to disclose the net cash value per share at the time of the business combination. This academic concept, which is equivalent to dilution, is now mandated in the final rules, and so the Chancery Court decided it was material and they wouldn't grant the motion. I believe that this disclosure requirement is as unhelpful in this context as believing that any IPO investor makes an investment decision in an IPO because of the dilution charts, which are also mandated. Regardless, it doesn't matter anyway, since we are all now required to make that disclosure, unlike in any other public M&A transaction. So while this case is an ongoing real example of seeking to continue to avoid Delaware courts where you can, we continue to work with the staff to neuter this requirement, as well as many of the other provisions contained in the final rules. We are actively seeking to reverse the final rules from last year. Not because we believe any of the new requirements benefit shareholders, but because we believe leaving them in place simply leaves the wrong impression. Although not invented in SPAC land, the Bitcoin treasury structure, as first engineered by MicroStrategy, has ignited a torrent of activity in our space. Iterating on that recognized alternative to cash management, Cantor Equity Partners announced a $3.6 billion business combination transaction with Tether and SoftBank and captivated not only the SPAC industry, but other public companies with Me Too strategies, but also triggering a range of new and innovative derivative conceptual approaches. All of this energy is cleverly being used to brainstorm novel use cases for crypto treasury strategies customized to work in a de-SPACing context, while also attempting to anticipate for the regulatory developments that may spur even greater change. We believe that we are only in the early days of this broader cycle. But if you ask my team, they're overwhelmed with the number of these types of deals that are coming on, and it's extremely exciting. You can't imagine, though, the positive energy that even this opportunity has created. I'd say beyond what we observed in 2021. But to fully appreciate this moment, we need to remind ourselves of other times. Not to be a downer, but to appropriately set the stage. This moment in time has to be juxtaposed to past events that had the exact opposite effect in the SPAC industry and clearly demonstrate the importance of permitting the private sector to do what it does best. As I'm writing this, I want to time travel back to a few years ago with folks and remind ourselves of the absolutely unnecessary energy depleting exercise that many of us experienced together, and how 100 plus security lawyers, excuse me, from around the country were forced to convene nightly to seek to devise a response to the SEC's wholly fabricated warrant liability accounting fiasco. Ably led by Joel Rubenstein from White & Case, who sought to solve for a problem that the SEC accounting staff intentionally roadblocked, we as a collective industry spent a month scrambling to resolve a non-cash charge on a contingent issue that had been debated and thought to be put to bed a decade earlier. What a waste of time and energy, resulting in millions of dollars of wasted professionals' time and energy, and clients' money. The most distasteful experience in my professional life, just inexcusable. Now back to the regularly televised show. And here we are, at the cusp of the intersection between crypto acceptance and SPACs regaining mainstream utility to bring a new frontier to investor value creation and innovation. You're damn right I'm excited. For far too long, there are those of us who have fought to validate SPACs as a means of taking private entrepreneurship public, not as adverse selection to rejected and/or too early IPO candidates, but as a pathway to the public markets that the more established methods would otherwise turn from. I think we are here. Early in the year on Yelena's SPAC Notebook podcast, I presumed that 1/3 or more of all de-SPAC transactions are going to be crypto or crypto-adjacent transactions. We'll see, but I may have been too conservative depending upon how quickly the SEC is in clarifying its preferred path to crypto SEC compliance and registration. The issues are complex, but the already noticeable speed of action in moving the conversation forward with regulators has to be recognized and lauded. Issues range from how many more coins deserve cash status in addition to Bitcoin and Ethereum. Will XRP, Solana, and Circle achieve the same status? For actual operating crypto businesses, will operating domestic and international platforms that have operated outside of traditional regulatory frameworks be forgiven even if they come into compliance now? Are unregistered tokens issuances going to be permitted a pathway to compliance without requiring any rescission offerings? Will the SEC grant some sort of exemptive relief for SPACs to de-SPAC into permanent capital fund-like management businesses? What will FINRA, the exchanges, or state regulators do to accommodate for this new reality? Both the administration and SEC crypto task forces have their work cut out for them and how to accomplish the most that they can, cognizant that there are genuine investor protection concerns. It is actually breathtaking to think about. After numerous calls with the Division of Corporation Finance and the Division of Investment Management, we are so encouraged by their new orientation and seeming attention to all of these issues. It would also be short-sighted not to constantly be fully prepared for the possibility of a reversion to the past with future regulation and future regulatory administrations taking a different point of view. As best we can, we should, as an industry, work within the SEC and Congress to secure this new horizon with permanent laws to prevent, as best possible, a reinterpretation of the rules as the last SEC administration often found convenient to do. Forewarned is forearmed. Capturing this moment and savoring what may be the most exciting time in our collective professional securities experience will be challenging, but also rewarding. You'll all have to have your time to shine and participate if you position yourselves correctly and dare to learn the unknown. At EGS, we welcome the opportunity to work with you and encourage you all to seize the moment. Thank you.